Hello, this is Mi Jin Ho from the University of United States Stock Theory. Let's begin today's United States stock news for July 15th. Welcome once again to Mi Jin Ho, where we consistently uphold the fundamentals of United States stock investing. I think we should start today by reading a message left by one of our valued subscribers. This message is from someone with the username Naynurai7080. I think we're around the same age since I also really enjoy songs from the 70s and 80s. They said, I've been busy so I couldn't watch the video until now, but I finally finished it. I think they mean they just got around to watching this video. They also said they wanted to share their own experiences while watching the video. At first, I started investing in stocks with just a small amount because I was curious about what investing really is, and that's how I came across the Mi Jin YouTube channel. I heeded the advice and was fine even when the market declined. But then I began watching other YouTube channels too. It was a group that focused mainly on Tesla, and I always thought positively about Tesla's future. So I could relate to that. Even now I support self-driving. I think that's how it will be in the future. When the stock price started to go up even more, I bought more earlier this year. Strangely, I kept buying more and more. I sold other things, and then when there was a sudden crash, I thought, no way, and couldn't sell. I'm curious if any other members have had the same experience as me. I didn't have any cash, so when the crash happened, I couldn't buy more and ended up stuck. Then, encouraged by the Lord's video advice, I started selling little by little even at a loss, and this morning I sold the very last one. Of course, I took a loss, but I feel relieved and good at heart. I think I can just start fresh from tomorrow. It's been over a year since I joined the membership, and I also signed up for Choice Stock. I'm trying to be a little less greedy, and I'm cheering on with Mi Junim and the other members. A colleague I'm working with had a similar experience to mine. Beginners probably keep buying the same stock when it goes up. I don't think you should ever do that. So I think Miju's momentum strategy is really good. Thank you in advance for any advice, and since you sent me a thank you message in advance like this, I feel like I have no choice but to give you some advice. First of all, you said that when a stock goes up, you seem to keep buying the same thing, and that you should never do that. I also buy more stocks when the price goes up. That's what momentum investing is. Among the stocks I own, I buy more of the ones with the best price trends, and if a stock's price keeps falling and doesn't perform well, I reduce my holdings in that stock. That's the momentum strategy. But there's a condition here. There's one formula we need to remember. The stock price is earning times multiple. All stock prices are made up of these two factors. So for the stock price to go up, it's either one of these two factors, or both working together that make it happen. Sometimes the stock price rises as earnings keep going up. Other times, even when earnings don't change, or even when earnings are actually going down, the stock price can still go up. There are cases where the multiple, that is, the price-earnings ratio, keeps increasing, and as the valuation expands, the stock price goes up. Now, if we pause and think for a moment, when earnings go up and the stock price rises accordingly, as long as there's nothing unusual with the multiple, it's actually quite hard for the stock price to fall back down. That's because unless the earnings drop again, the stock price is likely to stay at that level. Of course, the valuation needs to stay at a reasonable level. On the other hand, if there's no change in earnings, or even if earnings are actually declining, but the stock price is going up, that means only the market's expectations have increased. In other words, only the valuation has gone up. In this case, if the market's expectations decrease a bit, or if some unexpected bad news occurs, the multiple can shrink and the stock price can plummet. So even when you're using a momentum strategy, it's important to check why the stock price is rising and what the reason is for the strong momentum. So if the fundamentals have improved significantly, and that's why the stock price is rising, then there's not much risk in buying more of that stock. Well, the best example recently was this. It was the same with Nvidia when its stock price kept rising from 2023 to 2024, and it was the same with Palantir as well, as Palantir's stock price kept going up. Every time earnings were announced, this logic was confirmed. What that means is, if you worry that the multiples are rising too much, then the company announces strong earnings again. When the earnings story supports it like this, even if the multiples expand, it's likely that this level will be maintained. That's how you can sum it up. Now let me give you one more piece of advice. In my case, there are stocks that I personally like, and there are also stocks that I feel attached to. So how can we solve this kind of problem? I mentioned this on a broadcast a few days ago, but I actually don't really know the individual stock returns of the stocks I'm investing in because I rarely check them. What I mean is, I have Nvidia, Tesla, Palantir, and I'm investing in various stocks. Even though I'm investing in nearly 20 different stocks like this, I don't pay any attention at all to how much return each individual stock is giving me. There are two reasons for this. Firstly, as long as the stock price rises, that's all that matters. So, which specific stock I invest in isn't that important. My goal is for the overall return and total value of my portfolio to increase, so I don't really care which particular stock goes up. And the second reason is this. When you pay too much attention to the returns of each individual stock like this, those returns keep affecting your decisions whenever you buy more or sell stocks. When you own stocks that have increased by 1,000%, 10 baggers, it's natural to want to maintain that return due to human psychology. As a result, you may find it difficult to buy more shares of those stocks. Say I have 100 shares with a 1,000% return, but if I buy 100 or even 200 more shares, essentially increasing my ownership, the 1,000% return suddenly drops a lot. That's why being obsessed with the return rate of each individual stock like this can negatively affect your investment strategy and investment decisions. I hope my answer was somewhat helpful to your question. Welcome to today's Big Juice and News for July 15th. I'll begin by sharing yesterday's hopes for the United States stock market. First, let's examine the S&P 500 map. Yesterday was also a bullish market. There seemed to be a lot more green than red, but for the tech stocks we care about, there are generally a bit more reds. So we can infer that the Nasdaq probably didn't do so well yesterday. Looking at the sector returns of the S&P 500 technology stocks recorded a loss yesterday. However, despite that, all three major indices still closed in positive territory. The Dow Jones was up 0.20%, the S&P 500 was up 0.14%, and the Nasdaq index rose by 0.27%. Now, when the market rises little by little every day like this, it can actually be quite scary. When stock prices surge, they often undergo a correction, a technical adjustment. But when the market keeps creeping up steadily like this, in many cases, these kinds of steady gains accumulate and end up creating a healthy and very good return. You can think of it as a temperature that's neither too hot nor too cold, just right. This is known as the Goldilocks scenario. Now, since there were more rising stocks yesterday as well, the breadth of the market actually widened. Now, the number of stocks trading above the 51-day moving average is 69.98%, almost reaching 70%, and the number of stocks trading above the 201-day moving average is also at 58.8%. This is the VIX, which measures market volatility. It's the fear index. The fear index is also staying at 16.79. As I mentioned yesterday, if the VIX is below the 200-day moving average, it means the market is generally maintaining stability. This can be interpreted as a positive sign. Next is the fear and greed index. The fear and greed index has risen to 76. So we can see that the market is getting a bit overheated right now. This is the kind of signal we can identify. Extreme greed is overflowing. You can see it as many investors are eager to make profits right now. Next is the market score provided by Choistargi. The market score is still at 95. So, looking at these indexes, I mentioned yesterday that even if there are stocks we want to buy, we need to hold back a little. It could keep running for a while, especially as I mentioned a few days ago, July is historically a month with very good stock returns. So there's a possibility that this positive trend could continue until the end of July. But the problem is, once it turns downward, it could also drop sharply. So personally, I think it's a bit unreasonable to believe that this good atmosphere will last forever. Next is Miju on top pick yesterday as well. Biz on top pick continued to show a steady rise. Palantir had the highest increase at 4.96%, followed by MicroStrategy at 3.78% and B2G at 2.85%. Talon Energy up 2.10%, Coinbase up 1.80%, Tesla up 1.08%, Google up 0.76%, Celestica up 0.75%, Meta up 0.48%, Broadcom up 0.44%, Amazon up 0.30%, Credo up 0.78%, and Trade Desk up 0.07%. The rest went down. AMD dropped 0.12%, NVIDIA 0.52%, Taiwan Semiconductor Manufacturing Company 0.75%, Vistra 0.90%, First Solar 0.98%, and Uber 1.57%. Bitcoin corrected by 2.57% and dropped to 116,000. Lastly, Nextracker dropped by 2.97%, recording the worst stock return. As you all know well, the Mijuan broadcast is a bit longer than other YouTube channels. It's at least 30 minutes, and many videos are over 40 minutes, which is quite long. Even so, when I put together the broadcast every day, I often feel that there's still a lot left to be desired. That's because I really want to share a lot of information with you, but due to the limited time, I have to select only the content that will be most helpful to you and just mention that. Yesterday as well, after the broadcast aired and I was watching the market, I found one thing that I felt was lacking. Let me tell you what that is. Yesterday, the 6 top picks that Choice Stock evaluated as the most attractive. This article with such a title, which I wrote, I really wanted to share it with you all. However, due to time constraints, I wasn't able to share this article with you during the YouTube broadcast. Now, let me briefly show you why I felt disappointed about this. Choice Stock is currently giving buy signals for 11 stocks. Among them, there were 6 top picks, including Mizon, which is considered the most attractive. Let's take a look. If we move on to the next slide here, these stocks are pricey, so they scored lower in the evaluation. That's how to view it. On the other hand, if you look at the next page, it praises that there are 6 attractive stocks. Google, Meta, AMD Trade Desk, Amazon, and First Solar. These 6 stocks are currently considered the most attractive investments according to the Choice Target algorithm. That's what it mentions. And then, if you look at the next page, there are also 3 stocks in the Mijuan top picks with rising smart scores, Credo, Broadcom, and AMD. Their fundamentals are currently improving. As I mentioned earlier, when fundamentals rise and the stock price goes up, there's a high chance that this upward trend will continue. So, you can see that this is a much healthier situation than just rising because of valuation. Now, there's a really important page I want to show you. Here, Choice Stock has selected 2 United States mid-cap picks that are good to buy right now. One was First Solar, and the second was Trade Desk. Well, I wish I had told you all about this yesterday, because Trade Desk's stock price is currently up by almost 14.97%, which is nearly a surge. I think I need to start by explaining why Trade Desk's stock price is soaring like this today. A very important announcement has been made. News has been reported that Trade Desk will be included in the S&P 500 this time. You're probably all very curious as to why it's suddenly being included in the S&P 500. The stock price of Trade Desk, a digital advertising company, surged 14% in after-hours trading on Monday. This is because it has been confirmed that Trade Desk will be included in the S&P 500 index. And what about S&P Global, which manages the S&P 500? They announced that Trade Desk will replace the software manufacturer Ensys as of Friday. Now, before that, what about Synopsys on Monday? They announced that they have received all the necessary approvals from the authorities to finalize the $35 billion acquisition of NCS that was announced last year. That means NCS will no longer exist because Synopsys bought NCS. In that case, NCS will be removed from the S&P 500. So a spot suddenly opened up, and you can see it as the Trade Desk filling that spot. Now, this deal will be completed around Thursday. Because of that, starting Friday, the Trade Desk will be included in the S&P 500 index. That's how you can sum it up. Now, as we all know, in most cases, Changes to the S&P 500 usually happen during regular rebalancing periods. This occurs once every 3 months. However, in cases like this one, where there is an acquisition, a specific company can be removed from the index irregularly and then it can be replaced immediately. That's how it works. Trade Desk has taken a big hit to its market capitalization this year. By 2025, the company's stock price has fallen up to 36%. While the good news is that after being included as a Mejon top pick, it's managed to maintain an upward trend of nearly 30%. Stocks often show an upward trend when they're included in major indices. There's a reason for this, right? That's because fund managers have to readjust their portfolios to reflect this change. I'll explain this part in more detail a little later. Trade Desk, with a market capitalization of $37 billion, is considered a large company that sits around the middle in terms of valuation within the S&P 500. For your reference, Trade Desk was founded in 2009 by Jeff Green and David Pickles, and it was listed on National Association of Securities Dealers Automated Quotations in 2016. It's a company with quite a bit of tradition, having been listed for almost 10 years now. And this company is headquartered in Ventura, California. As of December 31st, it employs 3,522 people. So you can see that it's actually a pretty sizable mid-sized company, more than you might expect. Now let's summarize the impact this news will have on the Trade Desk stock price. In my opinion, there are 4 main areas where positive effects could be seen. First and foremost, the most important thing is the inflow of passive fund capital. A passive fund refers to an index fund that tracks an index, right? For example, an index fund or exchange-traded fund that tracks the S&P 500 index, they are required to buy the stocks included in the index. They actually have to hold these stocks. Therefore, as a result, a large amount of mechanical buying flows in, and this becomes the most direct factor in driving up stock prices. What about index funds and ETFs that track the S&P 500? It's said that about $13 trillion are linked to them. That means the Trade Desk will be included starting from July 19. So around that time, there will inevitably be a large-scale forced buying demand. That's what we can expect. Now, the second point is about the company's recognition and the increase in its credibility and image. Being included in the S&P 500 serves as a kind of guarantee that the company is one of the leading companies representing the United States economy. That's how you should see it. The S&P 500 committee is responsible for the changes. This committee, they only allow certain companies to be included if they meet very strict criteria, such as market capitalization, liquidity, and whether they're consistently making a profit. So because of this, it sends a positive signal to investors, boosting the company's credibility and attracting more attention from them. That's how you should view it. Now, the third point is liquidity. A company's average daily trading volume rises significantly when added to the S&P 500. And there are studies showing that the bid-ask spread narrows. The bid-ask spread is the difference between buying and selling prices. A narrower spread means you can buy and sell at prices closer to your desired price. Now, when liquidity increases like this, institutions and pension funds will feel less burdened when trading in large volumes. Therefore, the buying base can naturally become broader, and it becomes an opportunity for more investors to participate. That's how you can look at it. Now, lastly, institutional investors' interest may increase. There are institutional investors who manage not only index funds, but also regular active funds. Now, these investors don't track the index, but they can't have performance that's too different from the market index. What that means is, for stocks included in the S&P 500, it's easy to think, I should include them in my portfolio too, if possible. Therefore, we can expect that this will likely lead to additional buying demand. It's important to note that this supply and demand effect is primarily concentrated in the short term, so it may be good for the next few weeks or months, but after that, things could change. In the long run, performance and growth momentum determine the stock price. Ultimately, fundamentals are the most crucial aspect. One more point. I've put up Datadog's stock price chart below, and the reason is that Datadog was added to the S&P 500 a week ago. So, at that time, the stock price surged by 15%, but after that, it dropped again by 10.5% up to now. In this case, there's a possibility of a buy the rumor, sell the news trend appearing. But the Trade Desk wasn't included in the regular rebalancing, right? No one was really expecting the Trade Desk to be added to the S&P 500 at this point. Therefore, I expect that the possibility of the stock price suddenly plunging in a short period, like Datadog, is relatively low in the future. Let's take a look at the trade desk's momentum indicators. Currently, out of 26 indicators, 7 are signaling sell, 7 are neutral, and 12 momentum indicators are suggesting a buy. The relative strength index below is 59.06, so the upward trend is being maintained and it's above 50. However, it's still far from being overbought, so this can be interpreted positively. Next is the 1-year stock price chart, and the chart looks really nice. As you can see here, there was a V-shaped rebound. After that, it was moving sideways, just moving sideways. The important thing is that it's hard to get past this line here. This is currently around $80 to $81 or $82, and it needs to get past this line to have a chance of surging up to the next resistance level. So the most important thing was whether it could break through the resistance line between $80 and $82. The problem is that at this point, the news of being included in the S&P 500 was suddenly announced. So, at a very technically important point, a huge positive factor occurred. This part can be interpreted very positively. But if the stock price fails to break through the $80 to $82 range and falls again, there are two moving averages right below. One is orange, that's the 21-day moving average, and below that, the green one is the 61-day moving average. It's stuck at $68. If it gets blocked here again and can't hold the $68 level, meaning it doesn't defend the 61-day moving average and breaks through, then there's a risk that it could fall all the way down to the bottom of this box range again. This is a crucial point at the moment. Will it break above $82, or will it fall below and break through the 61-day moving average? But the positive part is that since some very important news has been reported, I'm expecting that it will probably trend upward. Today, besides Trade Desk, there's another stock that's soaring in after-hours trading, and that's Nvidia. Nvidia's stock is also up nearly 5% in after-hours trading. Nvidia is a very heavyweight stock. So seeing it go up 4.83% like this, we can expect that there must be some big good news. Now, the good news this time is something we've been quietly hoping for. I mentioned this before during the earnings conference call 3 months ago. I said that through this earnings conference call, we could find two potential pieces of good news. One of them is that, from a long-term perspective, the Chinese market has been completely excluded. Jensen Huang announced that going forward, they will exclude Chinese market sales from their earnings reports. If you look at it the other way around, that's what it means. If the United States eases regulations on the Chinese market, it would be like giving wings to a tiger for Nvidia. Therefore, the earnings results and the future guidance did not include any revenue from the Chinese market at all. But if even a little more revenue comes in from China, or if the Chinese market opens up again, Nvidia's performance could improve tremendously. In that sense, the news announced yesterday is very significant. There was amazing news reported that Nvidia can now sell its H20 artificial intelligence chips in the Chinese market again, which is a huge positive development. Let's take a closer look at the details. Nvidia is returning to the Chinese market. This semiconductor company expects to be able to sell its H20 artificial intelligence chips in China soon. On Monday, Nvidia announced that the United States government has guaranteed license approval for the sale of the H20 in China. Nvidia expects to begin deliveries soon. Yesterday, through a company blog post, Nvidia said it had submitted an application to resume sales of the Nvidia H20 GPU. The United States government has already assured Nvidia that a license will be granted, and Nvidia stated that it expects to begin deliveries soon. And one more thing, what about Nvidia? They also announced the development of a new artificial intelligence chip, the RTX Pro GPU, for the Chinese market. They explained that this new chip fully complies with United States export controls and is optimized for digital twin artificial intelligence technology in industrial fields like smart factories and logistics. Back in April, the United States administration tightened the conditions for semiconductor export permits to China. As a result, Nvidia was effectively completely blocked from selling its H20 chips to China. At that time, Nvidia's chief executive officer Jensen Huang said that if access to their products was restricted, it would result in companies having to provide financial resources to Huawei in China. So he's saying that there's a strong competitor called Huawei, and this rival company will attract a lot of money. Now, the competitor Huawei will use those resources for research and development to compete with Nvidia. So the gap could narrow. He once warned that this is a very dangerous situation. Jensen Huang, the chief executive officer, says that banning the sale of the H20 in China is a very bad move, because thinking that this will block China's artificial intelligence capabilities is very ignorant. In fact, the opposite result will occur. If we, Nvidia, don't compete in China and just let China build its own rich artificial intelligence ecosystem. And right now, it's a very important moment for the world to spread artificial intelligence technology. Therefore, if a new platform is developed that isn't American, and if Chinese companies acquire such technological capabilities, eventually their leadership and technology will spread throughout the world. Therefore, they're arguing that we should let Nvidia continue to enjoy its golden age. So what about Jensen Huang last May? He announced that the decision to effectively ban the sale of the H20 negatively impacted Nvidia's revenue by a total of $10.5 billion across the April and July quarters. $10.5 billion is a huge loss. So there was an announcement that they suffered this massive loss in just 2 quarters because of the H20 chip ban. And last week, Jensen Huang met with President Donald Trump, and it seems that the meeting went very well. In a way, you could say that Jensen Huang convinced President Trump and brought about change, so he deserves praise for that. All right, let me sum it up in one sentence from Mijon. In my opinion, this news isn't just a big positive factor. It's a huge, extraordinary one. That's what I want to say. Let me give you some specific figures. Starting from April 2025, exports of Nvidia's H20 GPU to China have been banned. And one thing we need to know is that the H20 is a chip that only China buys. So if exports to China are blocked, it can't be sold anywhere else. So at that time, the first quarter, which refers to April through June, in Q1, there was a one-time inventory and purchase contract loss of approximately $4.5 billion. This doesn't actually mean that sales decreased. It's because of inventory and various other costs that the loss is estimated to be $4.5 billion. So what about the actual loss? A decrease in sales of $2.5 billion was recorded in the first quarter. Now let's discuss the second quarter, spanning from July to September, the quarter we're currently in. It was clearly stated in the guidance that about $8 billion in H20 related sales would be excluded. And why is it decreasing by as much as $8 billion? That's as much as 15% to 20% of the total quarterly sales. You can think of it as a company's sales suddenly dropping by 15% to 20%. The sum of the first and second quarter earnings is $10.5 billion. So you can sum it up by saying there was an unbelievable decrease in sales of as much as $10.5 billion. Therefore, it's reasonable to expect that a significant portion of the $8 billion in projected sales losses reflected in the second quarter guidance will be recovered. Additionally, they can sell the previously written off H20 inventory as a loss. They wouldn't have disposed of all of it. Therefore, since some of the inventory-related losses can be reversed as profit, it can make a huge contribution to margin improvement. That's something we can expect. Now, the guidance for the second quarter of fiscal year 2026 is $45 billion, and this figure includes the ban on H20 sales. Therefore, if there hadn't been such a ban, they could have originally made about $53 billion. It's doubtful that conditions will rapidly improve in Q2, so for now, it's more likely that we'll see a slight improvement from $45 billion. Now, here's the problem. The losses of $10.5 billion, $2.5 billion in Q1, and $8 billion in Q2 should be recovered in the second half of the year, correct? In the second half of the year, there's a possibility of recovering up to $12 to $16 billion. They can sell unsold items from the first half and potentially make additional sales in the second half. Even in the worst case, $12 billion in additional sales are possible, and up to $16 billion if things go well. That's just in China. If that happens, there is enough basis to raise the annual sales forecast for the 2026 fiscal year by at least 4% and up to 8%. That's the expectation. NVIDIA's net profit margin has consistently surpassed 50% over the past year, maintaining a level above 51%. So what that means is that if sales increase by $1, net profit increases by at least $0.5 or more than 50 cents. So if the fiscal year 2026 sales go up from $12 billion to $16 billion, which is actually higher than the previous guidance consensus, even with a conservative estimate, the earnings per share outlook can increase from the current $4.30 to as much as $4.56 to $4.64. If that happens, the earnings results will go up by about 6% to 8% compared to the previous outlook. To reiterate, the stock price equals earnings times the multiple. If the multiple stays constant and earnings per share increases by 8%, the stock price could potentially rise by an additional 8%. That's what we can anticipate. Moreover, most of the $4 billion in inventory provisions could potentially be reversed in the latter half of the year. The $4 billion expense was recorded as a loss, but there's a high likelihood it will disappear. If that occurs, Gap's gross profit margin could recover to the mid to high 70% range, so we can expect additional earnings growth. Now, of course, there was a period of about 3 months when sales were banned, for about 3 months. Because Huawei and local Chinese competitors have put in a lot of effort, it will be difficult to immediately regain the overwhelming market share they had in the past. It may take some time. However, even so, considering the strong competitiveness of NVIDIA's Compute Unified Device Architecture ecosystem, major Chinese big tech companies such as Alibaba, Tencent, and Baidu are still likely to prefer NVIDIA chips. Since there is currently an artificial intelligence competition going on among them, they are naturally eager to use the best semiconductors. Therefore, this news is expected to be a decisive turning point that removes the only obstacle to NVIDIA's performance, exports to China, and restores confidence in its continued growth. The last content prepared for today is the Mijon podcast. Today's main guest on the Mijon podcast is Broadcom, another beneficiary of artificial intelligence. Earlier, we confirmed that there was a huge positive development for NVIDIA stock. But NVIDIA is the company with the highest market capitalization, and it's the leading stock among artificial intelligence beneficiaries. So, when such a huge positive event happens to NVIDIA stock, it's reasonable to expect that not only the overall market, but also other artificial intelligence beneficiary stocks will likely experience a positive atmosphere. So, at this point, it's very important to take a look at the atmosphere surrounding artificial intelligence beneficiary stocks. Now, this time, let's hear the argument that Broadcom has the potential to rise further, that its stock price could go up even more. Now, let's neatly summarize with John Paquette what logic this article uses to predict a further rise in Broadcom's stock price. That's all for today's broadcast. When I asked for your comments on yesterday's broadcast, many more of you than usual left me valuable comments. Let me say it again, reading your comments is the most fun and enjoyable part of my day. Even if it's a bit of a hassle, your comments help me run the Mijuan channel with a happier heart. Your valuable comments, questions, and feedback, even criticism, is welcome. As long as it's respectful, I'm willing to accept criticism too. I would appreciate it if you could leave your various opinions. Let's all keep fighting together until the day we can all retire through investing in United States stocks. Have a happy day, thank you. Hello, Mijuyun family. I'm back again with another analysis article. How do you like the podcast delivered with my artificial intelligence voice and Omiju's artificial intelligence voice? It's still not completely natural, but do you think it's at a decent level?
Hello, this is Omiju. My daughter also says that Miju's voice sounds natural, but mine sounds too much like artificial intelligence. I sincerely hope that at least the content will be helpful for your investments. Today, the material we will be diving deep into together is the latest analysis on Broadcom. Especially for the Mijun family, I know many of you are interested in tech stocks, particularly those related to artificial intelligence, so today's discussion will be especially interesting for you. The material we'll be looking at is an article dated July 15th, 2025. The title alone is striking. Broadcom still has a long way to go.
In this analysis, we'll examine Broadcom's growth engine, particularly artificial intelligence and the newly acquired VMware. We'll focus on how that synergy affects the stock price, and also why analysts still believe it can go up. looking closely at the reasons behind that view.
What's surprising right from the start is that Broadcom's stock price has risen by as much as 65% since August 2024. Broadcom's performance significantly outpaced the S&P 500 index's 12% rise.
Yes, that's right. It's an incredible achievement.
So let's take a closer look at what exactly led to this kind of performance and why analysts believe this isn't the end yet. As expected,
The biggest driving force is artificial intelligence. The article points this out directly as well. Artificial intelligence infrastructure investment is no longer just a passing trend. It's now considered a key driving force leading to a structural change across the entire industry, and there's a consensus in the market about this.
so Broadcom is at the center of that change, is that what you're saying? That's because they provide essential technologies like servers and networking, which are crucial for running artificial intelligence models.
That's correct. If you look at the figures mentioned in the article, in the recent earnings report, artificial intelligence semiconductor sales rose 46% year over year, and artificial intelligence networking sales surged by over 170%, which is truly impressive.
It's 171%.
Yes, since this accounts for about 40% of the total artificial intelligence related sales, you could say that artificial intelligence is basically driving the performance. Especially, there are hyperscalers like Google and Meta. These are large-scale cloud companies.
Yes, this.
The demand for custom artificial intelligence accelerators, called XPU, is growing rapidly among companies, with double-digit growth. Experts predict an explosive increase in demand during the latter half of 2026.
That fits perfectly with the outlook that big tech companies like Microsoft and Amazon will continue to invest aggressively in artificial intelligence. Cloud infrastructure investment is projected to reach nearly $392 billion by 2025, indicating continued market growth.
Yes, that's right, but this analysis also emphasizes that Broadcom's appeal isn't just in artificial intelligence.
Really? What else is there?
It's the effect of acquiring VMware. Through this, the strengthened infrastructure and software sector become another powerful growth engine and a key to improving profitability.
That's the part, right? Although Broadcom is mainly known for semiconductors, software actually plays a larger role than expected. What specific advantages does software bring to Broadcom? Yes.
What this software division does is help companies strengthen their data security, improve information technology operation efficiency, and since things are getting more complex these days, it provides essential solutions for managing environments like hybrid clouds. But the really important point here is that the profitability of this software division is much higher than that of semiconductors.
Much higher? How much higher? Yes.
The last 12 months, data shows the software division's operating profit margin at 73%, while the semiconductor division is around 57%.
73% versus 57%. That's a significant difference. So can we say that the Broadcom acquisition not only increased the company's size, but also fundamentally improved its structure?
That's right. In fact, due to the Broadcom acquisition, the proportion of software sales was about 21% in 2023, but by the second quarter of 2025 on a last 12 months basis, it has jumped to 44%, more than doubling. This has significantly boosted the company's profitability and earning stability per the analysis. And there's an ongoing project right now which is converting Broadcom customers to a subscription model. About half of this has been completed, and it looks like it will take about another year and a half to finish.
Switching to a subscription model.
Yes, this is crucial. We anticipate it will provide more stable and predictable revenue compared to one-time license sales.
With strong earnings, how are you rewarding shareholders? Let's review the shareholder return policy.
Broadcom actively returns value to its shareholders. The analysis shows that in the last second quarter, they spent $2.8 billion on dividends and $4.2 billion on share buybacks.
Oh, that's not a small amount.
Yes, and another thing to note is that by steadily paying off debt in cash like this, they might be able to do another M&A in the future. They say that securing the financial capacity for this is their top priority. Since Broadcom has continued to grow through mergers and acquisitions in the past, you could say this is a pretty reasonable strategy. Then,
This is the part I'm most curious about. There are so many good points like this, so what is the current stock price like? Is it too expensive? What do analysts think?
they evaluated it, first of all, looking at the forecasts. With continued artificial intelligence investment and growth in the highly profitable software sector, the adjusted free cash flow for the 2025 fiscal year is expected to be $31.4 billion, and by 2029, this is expected to exceed $70 billion.
They predict that in 5 years, the annual cash flow will more than double, showcasing an incredible cash-generating ability.
Yes, that's right.
Based on this prediction and several assumptions, I calculated the target stock price to be $321.45. Based on the stock price at the time the article was written, there's about 19% additional upside potential. That's the conclusion, right? About 19%. Yes, of course, since discounted cash flow valuation is based on future predictions and assumptions. When making investment decisions, you need to fully take these factors into consideration.
I understand. All right, then let me summarize. So, this analysis sees that Broadcom has enough potential to keep growing and improve profitability, driven by two engines: strong artificial intelligence momentum and the successful integration of its software business through the VMware acquisition, right? Yes.
That's the key point. Broadcom isn't just a company that's good at selling artificial intelligence chips. The key is that its strengths in artificial intelligence hardware and its highly profitable software business are creating synergy, transforming it into a company that continuously generates high-margin cash. This is the main reason analysts see further upside potential.
The combination of hardware and high-margin software is really an attractive mix. Yes.
That's right. If we take it a step further, I think there's an interesting point we should consider. As mentioned in this analysis, one of the key drivers of Broadcom's growth has been continuous acquisitions. So, to strengthen itself further in the future, what kinds of technologies or companies might Broadcom consider acquiring? That's what we're thinking about. For example, it could be a software company that manages artificial intelligence computing more efficiently, or it could be a company with next-generation networking technology.
Imagining the answer to this question could become another interesting point to watch when following Broadcom in the future.
Thanks for joining me today. I'll be back with more useful info next time.
The beginning of any dream is important, so be a little ambitious and grow bit by bit every day. Enjoy today's journey. Even if dark times come, I'm not afraid. Retire with United States stocks.